I'm not exaggerating when I say this. If you can somehow manage to not make any of these 6 mistakes I'm about to share with you, you will instantly become a better trader. It's important to know how to trade, but it's as equally important to know how not to trade. These are the 7 biggest mistakes I see people making when trading. Let's just jump straight into it. The first and most crucial mistake I see people making is entering too late. Look, I completely understand why people make this mistake. It's a psychological emotion that is just embedded in our heads as human beings, and that emotion is the fear of missing out. If you don't know this already and you're a beginner trader, you never ever want to trade with emotion. It's a lot easier said than done, and if you actually pay attention to all these mistakes, almost all of them are emotionally driven. The sooner you stop trading with emotion, the sooner you start making money. Even the best of the best get caught up in their emotions every once in a while, and sometimes it's hard to realize when it's happening to yourself. But that's just exactly what separates the profitable traders from the unprofitable. It's just one of the things you slowly get better at as you gain trading experience. The most often time people trade with their emotions is when they start thinking they're gonna miss out on the party. I see this happen all the time. You look at the chart and you spot a really strong resistance line. You know in the back of your head if the price ever crosses this line, you can be pretty damn certain the price will go up from here. So your initial plan is you want to enter right when the price crosses this line. Now when day trading, a lot of the times you're looking at multiple different stocks at the same time. You got to look at screeners, news, different indicators, etc. And let's say you come back to the original stock that you were looking at, and while you were looking at some other ones, there was a sudden spike in price and the price skyrocketed past the resistance level just as you predicted. The only thing is the price is already way above the line and you're not in the trade. This is the exact point of what separates a great trader from an amateur. The amateur would start feeling emotions, thinking if they don't enter right at this very point, they're gonna miss out on so much money. So they enter as fast as they can, even though the price is way above their initial entry mark and they're taking up way more risk entering at a high price like this. A professional trader would have realized what's happening and just called it a missed opportunity and start looking for other and better plays, or maybe even wait for a pullback to happen so they can enter at a better price with less risk. My point is, if you're late, you're late. Don't get caught trying to chase the party and get burnt because you entered at the top, because most of the time it's going to look like this, where there was a sudden spike, you entered late, and it ended up being the top and started falling right after you entered. Stick to your strategy, stick to your game plan, and don't change it no matter what. If you miss the entry point, move on to the next opportunity or be patient and wait for it to drop to a better price. Mistake number 2, using too much money. Let's go over a scenario that I'm sure almost all of you have gone through in your trading career. Let's say you initially started trading with $100 per trade, a decent amount for you, but nothing crazy, and your trading strategy is actually working pretty well. You're following your strategy perfectly to a T, and you've been insanely profitable every single day for the past week, making $500. Then you get this beautiful, bright idea. Well, I've been trading with $100 every day, and I made $500. What if I started trading with $1,000 every day, so I can make $5,000? Now, let's just say in this scenario, $1,000 is a lot to you. This is an absolute terrible mistake, and I see beginners making this one so often. Why is this a mistake? Well, it's pretty simple. If you're trading with an amount that you're not okay with losing, it's without a doubt you will start trading with emotion. Whenever the price goes towards a direction that you don't want it to go, and your balance starts dropping a crazy amount fast because you're using a higher percentage of your portfolio, you're gonna start freaking out, making you panic sell more often than you normally would. Whenever trading with an amount that you're not comfortable with losing, it's almost inevitable that you will trade with emotion. Trading is not a get-rich job. It's about growing your account slowly and consistently. The sooner you realize trading is not a get-rich-quick scheme, the sooner you will start becoming profitable. Mistake number 3. This mistake I'm sure every trader has made, and it ended up biting them in the ass because of it. Not setting a stop loss. Especially in day trading, you should always be using a stop loss. There's no reason for you not to. Even including swing trading and long-term trading, there will always be a point in the chart where you can say, if the price ever goes below this line, I simply don't want to be in the trade anymore. It happens all the time. You see a trade, it looks extremely bullish, you enter with excitement because you think it's about about to go to the moon. You don't set a stop loss because your emotions of excitement and greed are blocking your clear thoughts, or you're simply just too lazy to set one. You go grab a coffee, come back, and the chart just absolutely tanked within 5 minutes, completely ruining your portfolio with a massive loss. And I've even seen it get worse from here, where people think to themselves, well, I'm already here at the bottom, I might as well just wait it out. Then the stock keeps dropping, and soon they absolutely have to exit the trade unless they want a $5 balance. There will always be a point on the chart where you don't want to be in a position if the price goes below that point. Some of you may like larger stop losses, some of you may like tiny ones. It doesn't matter how big or small it is, just have one. This next mistake I see people making is using way too many indicators. I know, TradingView has millions of indicators and you're almost like a little kid in a candy shop that can't choose which one they want, and they just end up choosing all of them. Sometimes I'll look at a beginner's chart on TikTok or Instagram or whatever the kids use these days, and it'll literally look like this, where they have millions of indicators, support, resistances, Fibonacci charts, and everything under the rainbow. There's absolutely no need for this. 1, you can't even tell what's going on, and 2, most indicators are just momentum indicators, so they're telling all the same story. Stick to one strategy. Don't think just because you add 4 successful trading strategies together that it'll make one mega trading strategy. That's not how it works. Use a couple indicators, use one strategy, and keep your chart clean and easy to read. The 5th mistake is a very easy one to avoid, but yet people still end up making it all the time. Trade with the trend. In basically all my trading strategy videos, they all have a common core strategy: trade with the trend. It's pretty simple. You want to buy when the market is going up, and you want to sell when the market's going down. I know, it's simple, but I still see way too many people trying to overcomplicate things and trying to buy the absolute bottom of a market. They will see a stock that has been dropping for the past month and they think they figured it out and found the exact bottom. What are the chances that out of the past month the stock has been falling, you have found the exact bottom right here? If a chart has been falling, it's more likely to keep falling. If a stock has been rising, it's more likely to keep rising. Now, you may be asking yourself, how do I know if a chart is in an uptrend or a downtrend? Well, I explain it in depth in a lot of my other trading videos, but I'll give you a quick explanation. You get on your trading platform, add a 200-day exponential moving average. If the price is above the 200-day EMA, it's an uptrend. If it's below it, it's a downtrend. It's really that simple. Now, of course, every trading strategy is different. For some strategies, an important part of the strategy is buying in a downtrend or buying the bottom. But for the most part, you should be thinking, I'm only buying in an uptrend and only shorting in a downtrend. It'll make your life so much easier when you trade with the flow of the market. The next huge mistake is one that a lot of people miss, and it can be the difference maker in you fixing your bad habits or not. Lack of record keeping. If you're a beginner trader, or even if you've been trading in the game for a long time, it's always good to keep track of your trades. You can always improve. Always. It's important to look back at your past trades to see what you did good so you can keep doing those specific things. But it's also nice to look back at your trades and see what you did incorrectly. To help bring your emotions and bad trades under control, it's always nice to have a trading log where you take a screenshot or even a video of the chart before you even enter. Write down why you want to enter the trade in the first place, whether it was fundamental, technical, or from a news article. Write down the exact point of when you're going to enter the trade, then when you're going to exit. This will not only give you a direct plan, which is what you should have in mind before entering every trade anyway, but it'll also show you if you yourself followed your own plan. Once you exit the trade, write down why you exited. What emotions were you feeling during the trade? What you did wrong? What you did right? Keeping a trading log helps you achieve 2 goals. The first is to make money. The second is to become a better trader. You might not succeed on the first goal, but you will absolutely succeed on the second goal. You should always and forever try to become a better trader after each and every trade. No matter how much experience you have, you can always improve. Trading reveals your weaknesses that you never thought you had, but it can also make you a stronger person learning from them. It's important to learn from your mistakes, not just keep making them. One of those mistakes is setting your stop loss too high or too low. That's why in this video, I tell you a secret trick that I use all the time to help place my stop losses in the best spot possible, so they don't get stopped out as much, but it's still an efficient stop loss. Go check that out, and I'll see you guys next time.